Growthpoint's annual performance demonstrates resilience and strategic focus in a challenging economic environment. The property investment company achieved a 3.1% increase in distributable income and declared a 6% dividend increase. Company CEO Norbert Sasse joins us now. Norbert, thanks so much for your time this afternoon. So we saw momentum building up in the first half, especially when it comes to property fundamentals here at home, inflation ticking lower, more interest rates coming through, and that playing out in earnings, right?
Yeah, no, absolutely. And specifically, I think, the two major contributing, well, there's probably three major contributing parts to the business for this result of ours. The one is the South African portfolio across all three sectors, and I'll expand on that a little bit more. Two is lower funding costs off the back of lower interest rates, as you pointed out. And then thirdly, the waterfront. The waterfront keeps performing, very, very well for us. But just back to the South African, portfolio, there's no doubt to my mind that property is a bit of a lag. There's a bit of a lag effect, given, interest rates and an interest rate cycle. So you first see interest rates coming down, and then you see property sort of recover. And it's fair to say that our view is that, the property cycle and, those that sort of live and have their lives in the property industry sort of will be very familiar with what we call the property clock. And, you go through cycles, and then you have overdevelopment, and then you have, big vacancies, then development stops again, and all these sorts of things. So where we are at the moment, to our mind, is that, we've sort of bottomed out. We're coming out of the cycle. We think that there's some growth coming through now, principally driven by the lower interest rates. And fair to say that it's been a pretty tough couple of years, obviously, after COVID, right? But the encouraging thing is that all three sectors are now contributing. Even office managed to stage a bit of a comeback in this set of results.
Norbert, and just keeping that in mind as we're looking at the SA portfolio, would you say that we are at the bottom of the office property slump? I mean, I look at your numbers, I look at other property players' numbers, and it seems like things are stabilizing. Is that the case, or are property companies becoming a bit more strategic about the kind of office property they hold and where the office property is situated?
Look, it's probably a combination of all of those, to be honest. And certainly our portfolio performance in the Western Cape in the office sector is very good. But that's supported by, again, let's call it the property fundamentals, with low vacancies and rental growth coming through because of the supply-demand dynamics. There's no doubt that there's more demand there right now than there is supply. So that's very, very healthy. And obviously, inflation in the property industry, or rather building costs, having escalated over the last couple of years, that's also supportive for rental growth in a market where you are seeing demand and the ability to develop new product. Regionally, there's no doubt Cape Town and KZN for us doing well. Gauteng has improved considerably, but we still, unfortunately, are sitting with quite large vacancies in Gauteng. And even though, we've seen dramatic improvement in the, let's call it the negative reversions on renewal, that is still negative. But, as an indicator, I can tell you that for the first time, in fact, last year we had a very nominal increase in office values. We had another increase in office values in terms of valuation. So there's no doubt that supports this, let's say, bottoming out. Again, the rhetoric across most big companies today is you got to get back to the office, more time in the office, that sort of stuff, and all of that's positive for for the office sector. We do, however, need economic growth, and I just saw a little print earlier today which suggested the half-year economic growth was only 0.7% GDP growth, which is that's not good for demand in the long run.
And would you say then, right, with the current economic conditions, the current economic environment, you just laid the ground in terms of where growth is at, does that support new developments?
Again, it regionally depends on the region,
Okay.
depends on exactly. So undoubtedly, Cape Town, yes, Durban on the Lelusha Ridge, because Durban's only a very small office market now. It's pretty much focused on the Lelusha Ridge. That's where our office properties are, and there's zero vacancy. We've got zero vacancy in our portfolio, but it's a smallish portfolio. It's only about 100,000 square meters. So very much dependent on those regional specific details of of oversupply, vacancy, etc. And I'd add to that as well infrastructure, and let's call it municipal infrastructure. There are just certain areas that just does not lend itself to new development, considering challenges in terms of, say, safety, security, water, sewerage, and electricity.
And let's talk cost saving. I actually wanted to zoom in on your renewable efforts, right? And whether that's shielded you from these higher electricity costs. I know not all your properties are green, but have you seen a difference when it comes to that cost line?
No, very much so. We've got over R1 billion invested in solar now across 80 solar plants in our portfolio. And we've got 61, almost 62 megawatt peak installed. So that's at maximum capacity. We can generate that amount of electricity, and there's no doubt that is adding to the bottom line. We did, I think last year we struggled a little bit to, let's say, with our systems to enable us to collect, the electricity, let's call it benefits in a sense. But that is all sorted out now. And if you look at, again, what drove the South African result, it's probably as much as top line growth. It was probably even more just cost consciousness, savings on costs, and better recoveries of these electricity charges and the likes.
And just before I let you go quickly, how comfortable are you with your debt levels, Norbert? I mean, there has been a lot of disposals over the past year to reduce debts. Are you done with that cycle, or will we still be seeing more disposals coming through?
Yeah, we've targeted a further R3.5 billion worth of disposals next year, so it's ongoing. The program of, let's say, improving the quality of our portfolio by selling older, less desirable buildings in nodes that no longer, we don't believe, support long-term capital growth, and reinvesting that money into nodes where we feel more confident about growth. So that's an ongoing process. That's part of the strategy of improving the portfolio. But to your question on debt, we're very comfortable where we are at the moment. The South African loan to value ratio is below 35%. Our interest cover ratio on the South African debt book is 2.9 times. Even on a consolidated group basis, we now are just on about 40-odd% LTV. Those are, targets we set ourselves to get to. And it actually now provides us, I guess, with a bit of flexibility and optionality in terms of, future growth opportunities and investment in new projects.
All right, let's leave it there, Norbert. Thanks so much for your time and taking us through the year that was for Growthpoint. That was Norbert Sasse, CEO of Growthpoint Properties.